A powerful tremor is shaking the American food industry. Not a natural disaster, but an economic shockwave that's reverberating through the heartland. This isn't just a blip on the radar, it's a fundamental shift that's sending shockwaves through every link in the food supply chain. Tyson Foods, a giant in the sector and a household name for decades, has shuttered several key processing plants across the U.S., signaling a dramatic change in the industry's landscape. These closures mark a significant retreat by a titan of the industry, leaving behind empty factories, silent production lines, and a sense of uncertainty that's hard to ignore. The impact is massive. Jobs lost, communities disrupted, and the food supply chain thrown into uncertainty. For many small towns, these plants were the economic backbone, and their loss is being felt in every corner of daily life. Tyson's decision to close facilities in states like Arkansas, Indiana, and Missouri is monumental, affecting not just workers, but entire regions that depended on these operations for stability. These plants were economic engines, supporting thousands of jobs and local businesses, from suppliers to restaurants and service providers. Their absence is creating a ripple effect that's being felt far beyond the factory gates. Their sudden closure has left a void and raised urgent questions about the stability and resilience of the U.S. food supply chain. What happens when a major player steps back so abruptly? This isn't just about one company, it's about global pressures, shifting consumer demands, and a strategic realignment that's forcing the entire industry to adapt. Supply chains are being tested, and consumer habits are evolving faster than ever. While the U.S. contracts, Canada is stepping up, expanding its food industry to fill the void left behind. Canadian companies are investing in new facilities, hiring workers, and ramping up production to meet growing demand. This is a calculated response to a changing landscape, not a coincidence. Industry leaders and analysts are watching closely, knowing that these moves will shape the future of food production in North America. The contrast between the two nations is becoming clearer, redrawing the map of North American food production. The balance of power is shifting, and new opportunities and challenges are emerging on both sides of the border. As of November 25, 2025, the full impact is still unfolding, the data is still coming in, and the long-term consequences are yet to be fully understood. Why did Tyson take such drastic measures? What does this mean for American workers and farmers? And how is Canada benefiting from this shift in production and investment? The answers involve a complex mix of labor costs, operational inefficiencies, international trade dynamics, and the relentless pressure to stay competitive in a rapidly changing world. Understanding this shift is crucial. It affects our food, our economy, and millions of livelihoods. The choices made today will shape what ends up on our plates tomorrow. The story is about more than business. It's about the future of food production in North America, and the resilience of communities facing unprecedented change. The ripple effects are just beginning, and their reach will extend for years to come as industries, workers, and families adapt to this new reality. The stakes couldn't be higher for both countries. Collaboration, competition, and innovation will all play a role in shaping what comes next. The next chapter is being written right now, and its outcome will define the future of food for generations to come. Tyson's closures weren't sudden or unexpected. They were the result of a series of mounting challenges that had been building for years, gradually pushing the company toward a difficult decision. They were driven by mounting economic pressures that affected not just Tyson, but the entire food processing industry. Rising operational costs, from utilities to raw materials, combined with aging infrastructure, made older plants increasingly expensive to maintain and operate efficiently. U.S. labor costs soared, with wages and benefits climbing higher each year, squeezing already thin profit margins and making it harder to stay competitive. Demand for certain meats, especially pork and chicken, dropped as consumers shifted toward plant-based options and alternative proteins, changing the landscape of American diets. An oversupply of chicken further depressed prices, making it nearly impossible for some plants to turn a profit, even as production continued. Logistical headaches persisted, with high transportation costs, supply chain disruptions, and delays making it harder to get products to market on time. Some plants were no longer in optimal locations, far from major markets or suppliers, which only added to inefficiencies and increased costs. Tyson's leadership decided to consolidate production in fewer, more modern facilities, investing in technology and automation to boost productivity and cut costs. Financial performance forced their hand, earnings fell, and the chicken segment posted losses quarter after quarter, putting pressure on the company to act. The boardroom saw underperforming plants as a drag on the company's future, and tough decisions had to be made to protect the business as a whole. The closures were a painful but necessary step to ensure long-term survival, affecting thousands of workers and entire communities that depended on these jobs. The move reflects a broader industry trend: adapt or fall behind, as food companies across the country face similar pressures and must evolve to survive. Tyson's retreat is a warning sign for the entire sector, highlighting the urgent need for innovation and adaptation in a rapidly changing market. The company is betting on efficiency, automation, and resilience over sheer size, hoping these investments will secure its place in the future of food production. The future of American food production is at a crossroads, and the choices made today will shape what ends up on our plates for years to come. The hardest hit by Tyson's closures are the workers and their communities, who now face a future filled with uncertainty and anxiety. Thousands of people have lost stable jobs overnight, plunging families into financial insecurity and forcing them to make difficult choices about their futures. In towns like North Little Rock and Corydon, the plant wasn't just a workplace, it was the economic backbone, supporting generations of families and shaping the local identity. Local businesses, from diners to auto shops and grocery stores, are now struggling to survive as spending dries up and regular customers disappear. The loss of tax revenue threatens not only schools and public services, but also the very fabric of community life, putting programs and resources at risk. Many workers have specialized skills that don't transfer easily to other industries, making new jobs hard to find and retraining a daunting prospect. Some families may be forced to relocate in search of work, while others must accept lower wages or part-time positions just to get by. The social fabric of these towns is fraying, as uncertainty and stress ripple through neighborhoods and long-standing relationships are tested. Former employees feel betrayed after years, sometimes decades, of loyalty and hard work, left to wonder what the future holds. Community leaders now face an uphill battle to attract new industries, create jobs, and restore hope to their struggling towns. The closures are a stark reminder of the risks of relying on a single employer and the vulnerability that comes with economic dependence. The scars left behind, empty buildings, lost opportunities, and shaken communities, may take years or even decades to fully heal. Tyson's shutdowns have rippled back to the farm. Farmers who supplied Tyson now scramble to find new buyers in an already saturated market. With fewer processing plants, farmers face lower prices and higher transport costs. Some are pushed to the brink of bankruptcy. Consumers may see price swings and reduced choices as supply chain inefficiencies grow. Consolidation into fewer larger plants makes the system more fragile. A single plant closure can disrupt the national meat supply. The closures expose the vulnerability of a system built for maximum efficiency. Farmers are left with unsold animals. Consumers face uncertainty at the store. It's time to question if this model truly serves the nation's needs. As the U.S. food sector contracts, Canada is seizing the moment. Canadian processors are expanding, hiring, and increasing capacity. They're filling supply gaps and boosting exports to the U.S. and beyond. Government incentives and private investment fuel this growth. Programs like Agri-Innovate help modernize plants and drive innovation. Canadian brands are appearing more on American shelves. This isn't luck, it's strategic preparation meeting opportunity. The turmoil in the US is sparking a boom in Canada. Maple Leaf Foods exemplifies Canada's rise. While US rivals closed plants, Maple Leaf opened a state-of-the-art facility in London, Ontario. Advanced automation and sustainability set it apart from aging US plants. The new plant boosts capacity and supports local farmers, creating a virtuous economic cycle. Maple Leaf's focus on technology and green practices appeals to modern consumers. The company is also investing in plant-based proteins, diversifying for the future. Hundreds of new jobs have been created, strengthening the local economy. Maple Leaf's dual strategy, meat and plant-based, positions it for long-term growth. This forward-thinking approach is why Canadian companies are thriving. US counterparts are struggling to keep up. Canada isn't just filling gaps, it's aiming to become a global agri-food superpower. The country's reputation for quality, safety, and innovation is a major asset. Government targets and trade agreements like the CPTPP are opening new markets. Investment in ag tech and food tech startups is driving rapid innovation. Hubs in Guelph and Saskatoon are leading the way in precision agriculture and alternative proteins. Canada is gaining ground as a preferred supplier, especially in Asia. The combination of quality, government support, and vision is creating momentum. The question now, can Canada surpass the US in the food sector? The answer is becoming clearer as Canada's strategy pays off. The world is watching this shift unfold. The future of food may be written in Canada. The US and Canadian food industries are following two very different playbooks. The US is focused on cost-cutting and consolidation, maximizing short-term profits but risking supply chain fragility. Canada is investing in new facilities, technology, and workforce stability. The Canadian approach prioritizes long-term growth and innovation over immediate returns. US plant closures mean layoffs and community disruption. Canadian expansion means new jobs and stronger local economies. Automation in Canada is about productivity and safety, not just cutting labor. These strategies reflect different philosophies: profit maximization versus resilience and community support. The Canadian model is proving more sustainable and beneficial. The contrast is stark, and the results are reshaping the continent's food industry. The future may belong to those who invest, not just those who cut. Tyson's closures and Canada's rise reveal the ruthless logic of the global economy. American workers and communities face real pain, while Canada seizes new opportunities. Companies like Maple Leaf are building a modern, diversified food industry. The US strategy of consolidation brings short-term pain and long-term questions. Canada's investment-driven approach is fostering growth and stability. The North American food map is being redrawn. The future will be shaped by labor, technology, and consumer demand. As we look at our plates, we must ask, what does this shift mean for our nation's food security and prosperity?